Last time I saw Warren Buffett behaving like this, with record cash, net selling, and no major moves, the markets were overheated and headed for a potential big correction. He didn't ring a bell yet, and he's not doing it now, but make no mistakes, he is the bell. Most investors are looking the other way right now. But the real question is, will you, or are you going to look at Warren Buffett's moves and realize where we stand in the market? Now, Warren Buffett's sitting on a record $341 billion in cash. That is billion with a B. That's 56% of Berkshire's portfolio and 1/3 of its market cap. Now, everyone's freaking out, saying, Paul, is he timing the market? Is a crash coming? We got to slow down. Buffett has always said he doesn't time the market, but history tells a different story. Back in 2008, when the world was melting, when the world was crashing, he had a mountain of cash and deployed $20 billion into beaten down businesses. And guess what? He absolutely crushed it. One of his biggest bets was $10 billion into Goldman Sachs. That was a vote of confidence for that company and for the U.S. economy. He even wrote an op-ed back then where he said, I'm betting on the U.S. economy long term. Now, Buffett did say something recently about this current market that some view as a hidden message. And before we get into that, let's look at these charts on what he has been doing as of late. Chart number 1, his cash from 1996 to 2024. Guys, he's been accumulating cash. Now remember, his business model, they're an insurance company. And he's always said we need to have a lot of cash on hand because we never want to be caught with our pants down if some big catastrophic insurance event happens in 1 year. So just keep that in mind as well. Chart number 2, this is cash by year. 1.35 billion back then and growing. Look at 08 and 09. I'm actually surprised by this to have so much cash in 09 at the end of 09, considering end of 08 to the beginning of 09 was a big market decline. But as you can tell here, his cash did go down 40% from the previous year when he probably spent a lot of money buying some stocks. Now, before I get into the third chart, I want everybody to remember, this is a very common theme out there. What is Buffett saying? So a couple caveats here. Remember, Buffett's goal, and he's always said, is it's going to be very hard to beat the market as Berkshire gets bigger and bigger. With all their stocks and all their businesses, they have over 150 different entities. When you're that large, it is hard to beat the market in full. In addition to that, when you have so much cash on hand, in order to move the needle, you must be able to make big investments. Well, how many places can you put big investments into? He can't go buy a $500 million company. Let's say he found a company that was worth $2 billion. He could pay $500 million for it. Great, he does it. Guess how much that's going to move the needle? Not at all. And that's the problem that Berkshire has. They're basically becoming their own ETF. And he's been very, very vocal that the bigger and bigger they get, the harder and harder it is to beat the market. Go look at his early years. He was crushing the market every year for 10, 12 years in a row. Nowadays, there are stretches of time in which he gets obliterated by the market. But remember, his goals have changed. So even though you should take guidance on where the market might be going based on his actions, you should not invest like he does. The year, 2020, all the way to 24, stock sales, stock purchases, and the net amount. In 2020, he did about $39 billion in stock sales and bought $30 billion. 2021, 15.8 versus 8.4. 2022, what happened in 2022, guys? We had a bear market. No coincidence here. Stock purchases were double his stock sales. 23, things got a little bit worse, and look at this. 2024, $143 billion in stock sales up against a purchase of $9 billion. Guys, he sold $134 billion worth of stock last year. That's not a typo. That's real fucking money. That's Buffett looking at this overpriced, hype-filled market and saying, nope, I'll just take the cash. Thank you very much. Remember, treasuries are paying 4%. He can put his money in 90-day treasuries, get 4%. And yeah, it's not great, but on $334 billion, that's $13 billion a year of cash. Guys, he only spent $9 billion last year. That's like going to the store with $100 and walking out with like a bag of M&Ms because everything is overpriced garbage. This is value investing, folks. You don't buy just to do something. In fact, Munger and Buffett always say the money is made in the waiting. You buy what makes sense when it makes sense. Buffett even stopped buying his own stock. Why? Because it's not a deal anymore. That's discipline. That's principle. Guys, this is the Buffett Berkshire slowdown on share repurchases. Check this thing out. Going back to 2020, buying back a lot of shares here in 2020. What happened in 2020? Does anyone remember what happened? Yes, we had a crash and the year ended up, but along the ways, he kept buying. He hit the brakes on Berkshire stock buybacks in 2024, and he hit them hard. After years of scooping up shares when they traded below intrinsic value, he spent just $2.6 billion in Q1, then zero for the rest of 2024. Why? Because the stock got too expensive. Remember, he's a different kind of CEO. He's not like those other CEOs who look at buying back shares as a manipulation to increase EPS. He looks at buying back shares as taking his company's cash and investing it. He looks at that no different than investing in Coca-Cola or American Express. When he buys back his own shares, he's investing back in his own company. He thinks the stock is sitting at a premium, and that premium could be 60% to book value. And Buffett, being Buffett, sticks to his principles, only buys when it's a deal. No emotional FOMO, no chasing, purely logic. If the price isn't right, even for your own company, you sit on your hands and you do nothing. That's the kind of discipline most investors talk about, but rarely follow. And keep in mind, he can sit on his hands because he doesn't need the money. That's a big key here. The way I invest is going to be different than the way you invest. The way Buffett invests is different than the way I invest. You have to remember that over and over again. Now, Buffett is usually very vocal when the market is undervalued. He put that op-ed back in 2008. Now let's walk through some of those biggest moments when Buffett didn't just talk about value, he put his money where his conviction was. No speculation, no CNBC hype, just rational investing. In 1979, inflation was brutal. Bonds looked like a safe play and everyone hated stocks. What about Buffett? He wrote, "You pay a very high price for a cheery consensus," and said, "I'm a huge bull on the American economy." Translation, stocks were cheap and he knew it. How undervalued were stocks back then? Guys, look at this. This is 1979 right here. 1979, 58% undervalued. Today, we are 100% overvalued. So, stocks right now, according to this stock to GDP, means the S&P should sell at 2,800. This would be the equivalent of the S&P selling today at 1,400. That's how undervalued they were. What would you be doing if S&P was at 1,400? Now, the vast majority of people out there would say, I'd be absolutely buying a ton. Spoiler alert, 99% of people out there would not be. You know why? Because they'd follow the stock prices. And back then, where was the S&P? The S&P was 110, 103. Well, let me show you guys what ended up happening. Actually, 1968, look where the S&P was. That was 11 years of zero gain except for dividends. 11 years. And when he wrote this article back in 1979, look what happened. In 1982, where was the market? 110, 115. He had 3 more years of the market going nowhere. He had 3 more years of, if it was modern day time, people would be saying, what an idiot. Look at him back then. How do I know this? We hear it all the time. We hear it all the time on this channel. People look at the previous results, the immediate recency bias, and say, was I right or wrong? And I've always said, even on companies like Alibaba, which were up 60, 70% at one point this year, people were saying, Paul, how does it feel to be right? I go, I'm not right yet. I will be right 10, 20 years down the road, 5, 10, 20 years down the road. It's not right because of 2 or 3 months worth of market movement. I cannot take credit for that, just like I wouldn't take criticism or care about the criticism the stock was down in 2 or 3 months. Now, back to Buffett. Then came 1987. The market dropped over 20% in one day. Everyone ran for cover. Buffett, buying quietly. No headlines, just discipline. Now, fast forward to 1999, the dot-com frenzy. Everyone was chasing tech like they were Beanie Babies. Buffett stood alone, saying stocks were overpriced. And when the bubble burst, he went shopping while others were licking their wounds. In fact, in Sun Valley, there was a big event. And he wrote in the book Snowball, it starts out with him at this event talking about overvaluation. And people are like, this old dinosaur doesn't even get it. Guys, he was freaking 65 years old back then. He's 94 now. He got it back then. He gets it now. But 2008 was his boldest move. Buy American. I am. That was his article. So while panic spread, he shifted heavily into stocks. Not because he felt bullish, but because the math made sense. COVID hits. Markets crash. What does Buffett do? He buys. And now, what's he buying? Japan. 5 trading houses have been accumulating since 2019. Low PE, strong moats, great shareholder value because the owners of the company act like shareholders. They know their job is to benefit the shareholders. So what's the bottom line here? Buffett doesn't chase hype. He waits for the market to serve filet mignon at hamburger prices, and then he loads up the plate like it's $7 all-you-can-eat buffet. That's value investing. That's Buffett. That's how wealth is built. I have a huge pet peeve. Warren Buffett, I used to be a shareholder of Berkshire, and I got tickets to go to the event. I've never gone and I never want to go. Why? Because I get so incensed and upset when everyone quotes Buffett and then does the exact opposite. Or worse yet, they buy hype and then they use Buffett quotes to justify that hype. Example, Bitcoin. I love seeing Bitcoiners sit there and quote Buffett, the very guy who thinks Bitcoin's an absolute scam. And when Bitcoin's down, they say, be fearful when others are greedy, be greedy when others are fearful. Shut the fuck up. Actions are one thing, words are another. Which one do you want to look at? Look at people's actions versus their words. Let's break this down. Buffett said, just in February, often nothing looks compelling. Very infrequently, we find ourselves knee-deep in opportunities. Now, when did he say that? He said that in his annual report, his letter to everybody. And suddenly everybody's like, is this a sign? Should I sell everything? Calm down. This is normal. This is what value investing feels like 95% of the time. And you're in a different position than Buffett. You've got a dollar cost average into low cost ETFs, not worrying about the market. Because over time, the market does this, but the price does this. If Buffett stays out over here or over here, his life is exactly the same. His shareholders' lives are probably the same. But for you, the average person looking to save money for retirement, you got to be in the market at all times. Most of the time, we're staying on the sidelines, arms crossed waiting. That's what value investors do. But you have to invest the way your life dictates. Opportunities don't show up every Tuesday like your Amazon packages. They're rare. But when they do come, oh boy, you better be ready to pounce. Think about 2008. Think about COVID. We were knee deep in deals. That's when the market was practically begging you to take its money. But what was going on back then? People's fear took over. Both situations. The financial world's collapsing. We're not going to have an economy. Both situations. And guess what happened? We rebounded. We always do. And here's a great line I heard recently. Why should you be buying when the world is going to fall apart? If the world does fall apart, guess what's not going to matter? Your money. So you might as well put that money to work and buy cheap companies. Because if everything does go to zero, you're not going to care. You're going to care about how much land you have, how many guns you have, and how many cans of food you have. You're not going to give a flying fuck about fiat currency, Bitcoin, anything. When you have your goal, you've gone into our retirement calculator, you've put your goals, and you save every month dollar cost averaging. Anything extra that you choose to buy, individual stocks, you've already reached your goals, be okay waiting. Be okay waiting. As long as you're hitting your goals for retirement, don't take away from that. Let others chase the hype. We will wait for value to come to us. You're going to be part of that. So when Buffett goes quiet and stacks cash, the smart money pays attention. But what have I told you? This time, it's not just about value investing. There's a bigger game being played, one that could shake the market in 2025. We're talking about forces behind the scenes, political strategy, debt pressure, and deliberate economic maneuvers. If the dots we're connecting are right, this crash isn't going to be random. So click the screen to watch the 2025 stock market crash is not an accident. Because if this theory that's out there holds up, the moves you make next could define the next decade of your financial future. Click the video on your screen. Thank you very much for your time.